Okay, hardcore corporate governance people, you're still with me. Well done. We're looking at the business structure now. So, what sort of business is it, and what effect does it have on corporate governance? This comes up a lot in the exam. Excuse me. Family controlled, family run businesses. Well, if it's a family running it, then they're the shareholders, they're the owners. So, agency costs disappear. They become very minimal. Also, because it's a family, you can take a longer term view. You're not worried about your bonuses, etc. You're more worried about, well, you leave something for your children often. So you can take a nice longer term view and not go chasing short term goals. And often you may say that ethics are stronger within the business. You're not looking to defraud the business, etc. It's all people, it's all your family. So ethics should be stronger. There are some problems, though, associated with this as well. The obvious one, family feuds, and the problems that that might cause, particularly if you've got key players within the family. And secondly, the ability, particularly as it gets handed down. Often it's the brainchild of one person, and then it gets handed down, and the ability to run it as it becomes a little bit old-fashioned, that gets called into question. Now, over on the other side, insider dominated. I say over on the other side, it's very similar actually. It's just a few smaller groups. So a few groups of big shareholdings. Okay, and they tend to have quite a lot of those benefits as well. A few groups of big shareholders, well, therefore they can look after themselves. They don't have that many agency costs. They can afford to take a longer term view. Ethics stronger again, just looking after themselves really. Not too worried, not trying to defraud the business. But you can get a few problems as well with this sort of business. A few problems to look for in this scenario. That any minority shareholders, and this is the big one, they're left out. They don't know what's going on. There's a lack of transparency. Okay, I'm going to put that in there because it's so important. A lack of transparency. Because the major shareholders, those few groups, they all know what's going on. So they tend to forget about the minority shareholders. And therefore you could claim that there's an abuse of their power. And would you really want to invest in that sort of company knowing that you'd be a minority shareholder? Probably not. Then over on to the international side, if you're across multiple jurisdictions, where shall I put that? Should put it somewhere. When you're across multiple jurisdictions, I know that's pretty obvious from an international viewpoint, but different jurisdictions have different views on corporate governance. So you've got, first of all, you've got the OECD principles. Have a look at the textbook for this. I'll go through this in a bit more in the textbook, but basically it's a framework for governance that they give. They talk about shareholder rights. You don't need to know these in any details. Have a quick look at the textbook and that would be enough. Shareholder treatment, how you treat the minority shareholders, how you treat stakeholders, and what's the role of the board and what disclosures should be given. Okay, like I say, have a look at the online textbook. Then there's the International Corporate Governance Network, International Corporate Governance Network, and that does a similar thing really, but it really says that investors are key. You've got to keep them happy, okay? And so it's just, again, a list of international principles that should be followed. You don't have to know very much about that at all. Okay, so just be aware of those three types and their effect on corporate governance.